Okay, so let's talk about mortgage payments and if you were just to pay a little bit extra a month, how it would significantly pay your mortgage loan amount down. All right, so if you look at the mortgage calculator here on bankrate.com, typical home price 425,000, down payment 20%, 85,000, 30 years interest rate today is about 7.99%. And so if you look at your payment breakdown, you're about $2,838 estimate on principal and interest, property tax, that type of thing. All right, so if you look at the amortization schedule, your loan amount is 340,000. Total interest paid over those 30 years, $557,759. Total cost of the loan, $897,000. So it's basically double what the home price is, right? And so if you look at the amortization schedule here, you'll see since we're in November, we've only got 1 month here, but we're just paying a little bit of interest and principal. But if you look at 2024 next year, those payments of the 2838 a month after the whole month or the whole year, you're paying 29,300 in interest. So it's mostly interest. 3,000 of that would go towards the paying down the actual loan amount, so the principal. Right, the next year it sort of doubles, but you look at that, you're still paying just a ridiculous amount of interest payments. So the first 20 years, I mean, you can see it's just all interest payments that you're paying. Hardly any, if we go down to 10 years from now, you would have paid 259,307 in interest payments alone. You would have only paid your loan amount down by $42,000, right? So your balance after 10 years is still $297,000. So almost $300,000 on the loan amount. It's only gone down by 40,000 after 10 years of payments. All right, so let's look at if you were to pay an additional $500 a month. So, finding an extra 500 might be tough, but considering if you didn't have any car payments or any other debt, right? No credit card debt, that type of thing. You just took an extra $500, paid it towards towards your mortgage every month. What it would do to your actual balance, right? So we look at 2033, you would have paid $134,000 down towards the principal and the same amount of interest. But now instead of owing $297,000, you only owe $205,000. So you would have paid your mortgage down by $92,000 just by an extra 500 a month. So if we increase that to, if you could do like $700 extra a month, then you look at the same after 10 years, you would have paid 171,000. Now you would have paid your mortgage down to $168,000. So you would have paid it down an extra $129,000 just by adding an extra $700 a month payment. And so this is why it's crucial to look at if you're going to stay in it for any length of time. Most people stay in their home 7 to 10 years before moving. If you could just pay an extra any kind of amount per month to that principal, it pays it down significantly, right? So if you remember before that first year, we only paid 3,000 towards the mortgage, right? So if I get rid of this and make it zero again, that first year, 2024, we only paid 3,000 towards the mortgage. If we add an additional 700 to that payment, now you've paid an additional 12,000 a year towards paying down your mortgage. Since it's your biggest asset, again, after 10 years, you would have just increasingly paid down that mortgage just by adding an extra, a couple $100 a month to that payment. So this is the best way to pay the loan down quicker, and in that 10 years, hopefully the value of the home has gone up as well. So I hope you enjoyed that. Like and subscribe.